6%. So let's get right to the floor show because we've got a lot of moving parts here. Joining me now, BlackRock's global co-head of fixed income ETF, Steve Lapley, and Great Hill Capital chairman Tom Hayes, who says, you know what, it is possible to brace for a correction but still be bullish. What do you mean by that, Tom? How do you do that?
Well, Warren Buffett had a famous saying. He said, beware of geeks bearing formulas. And the narrative of the market for the last 2 months has been AI and Bitcoin. Well, AI is going to change the world. It's just not going to do it by next Tuesday. The market is up 16 out of the last 18 weeks. We haven't had a 2% correction in 87 trading days.
A measly 2% correction?
Measly 2% correction. So last week and a half, we were on the network for the first time. And you know I've been bullish for the last year and a half, even when it was very, very lonely. We did put a portfolio hedge on, index put spread, to dampen volatility and to give us some excess capital if we get a 5 to 7% pullback to get long and constructive into year end. So we are constructive, we are fully invested, but now we are hedged for a normal seasonal pullback.
Well, you initiated a tactical short. Give that to our viewers in plain English.
Yeah, so we went out a couple of months. During the election years, February, March, April tends to be a weak part of the season. We've run up quite a bit. Earnings are good, but we're trading at 20.5 times forward earnings. That's a little rich. How we expressed it, a little bit out of the money S&P put spread. So you buy the near strike price and you sell the lower strike price. So if the market moves that 1% of equity capital, if the market pulls back 5 to 7%, we make 5x on our money, which gives us nice portfolio dampening.
Steve, we had a lot of equity records. We also had some pretty significant bond records, at least certainly year over year. When you look at the record when it came to inflows into bond funds, $300 billion, $203.7 billion of that was here in the U.S., and you guys got a huge chunk of that over at iShares. Does that continue, and in what form?
Yeah, I think we're pretty bullish on it because if you look at the landscape today, we're at yield levels that are greater than they were 20 years ago, which I think is pretty remarkable. And so there's tremendous opportunity in the bond markets right now. So we saw investors deploy over the last 2 years. You know, granted, some investors were early. We did have that run up to 5%, but now, as we could see even from today's price action, you know, we've retraced. We could probably be sideways here for a while as everyone sort of sorts through what the Fed's posture is going to be. We're going to get more information on that this week. We're going to get more data coming in. But we're very bullish on the idea of upping your fixed income allocation. We think investors have been fairly underweight fixed income even after these flows. So we think there's a lot of room to run.
Okay, so what is the best actual trade? If you were trying to look at the yield, considering also the current potential upside valuation gains as rates fall, I mean, this is a lot of cross currents your investors have to be faced with.
Yeah, there are a lot of macro factors that do need to play out. You have to have a view. So if you're in the soft landing camp, then risk assets are attractive. So even at these tight spread levels, high yield offers excellent carry.
What if I'm in a hard landing scenario?
If you're in a hard landing scenario, you want high quality duration. So that can mean long dated investment grade or even more long dated treasuries.
How long? 5, 7?
Well, we saw a lot of flows go into TLT, our 20-plus fund, last year. We saw over $20 billion go into that fund. So we'll see if those flows pick back up again.
Well, again, just because the herd is doing one thing, Tom, doesn't mean that each investor has to do the same or follow that herd. What are you doing differently beyond what we've just talked about?
As you know, they call me Turnaround Tom for a reason. We like dramatically out of favor companies that are high quality companies. So one is Advanced Auto Parts, which actually got upgraded today. The CEO, Shane O'Kelly, he came from HD Supply, which was a $7 billion business for Home Depot. Advanced Auto Parts is down 70%. He's been in for about a quarter. Before he could even find the coffee machine, he took $150 million of costs out.
He's one of those.
He's one of those. He's selling off the Canadian business. He's going to delever the balance sheet. He's going to simplify the supply chain and distribution centers. And he took guidance up in his first quarter. He took earnings guidance up 10%. And he said we're going to have at least $250 million of free cash flow next year, which is critical in a turnaround situation because you need the runway to get the turnaround in place. We talked about it on the network in the mid-50s. It's now up over 70. We think this can go to triple digits over the next 12 to 24 months.
Well, really quickly, Steve, Jay Powell is speaking tomorrow and then Thursday. What are you expecting from him, and when are you expecting the first rate cut?
I think what we're expecting from him baseline is he's going to reinforce this narrative that they can be patient, they can continue to watch the data come in. The market's pricing that in. Tom and I were talking before the show just how it's shifted. We've shifted from, as many as 6 cuts to, a little over 3.5 at this point. I do think the market's sort of centered on, around June. So we'll see if that plays out. But I think he's more than likely going to reinforce that message. Okay, guys, we got to run. We are now very close to session lows, particularly with the NASDAQ. The NASDAQ session low, new one, 329-point loss. We're down 324 points. Steve, Tom, always good to see you both. Thank you very much. It may seem